And if you master these four figures, their logic of formation and price movement, you will always be able to earn in the market under any conditions and circumstances. So, before you are the four main figures of technical analysis: triangle, double top touch, head and shoulders, and cup and handle. Before we proceed to analyze these figures, it is important to understand that they are divided into two types: continuation patterns and reversal patterns. The key to success in trading with these patterns lies in our understanding of the logic behind price movement and the formation of these patterns. Every second, there is a struggle in the market between bulls and bears, that is, between buyers and sellers. It is the result of their struggle that leads to the formation of price and the development of certain patterns in the market. So, let's analyze the market structure and momentum together. So, the structure can be upward, as you can see on the left side of the screen, and downward, as you can see here. A structure is referred to as upward whenever each subsequent peak in the price movement is higher than the previous one, and when each subsequent low is higher than the previous low, in the case of an upward structure. In the case of a downward structure, it is exactly the same, but in reverse. At the moment when the price starts to form new highs that are above the previous ones, the lows will also be above the previous ones in the case of a downward structure. We will be able to understand that our market has reversed and we are entering an upward structure. The same applies to a downward structure. The same. For a proper understanding of the market, it is important to note and understand that we have a major upward structure and a minor structure. This is the same structure, only on smaller time frames, that exists within a more global price movement. I also cannot overlook the strength of the bulls or sellers in the market. In this case, we see an upward structure, meaning an upward trend. By the distance between each subsequent peak, we can slightly determine the momentum in this case. The greater the distance between the peaks, the stronger the overall interest of buyers is, in this case significantly for purchases in the market. If the distance between each subsequent peak decreases, it indicates that the strength or interest of the buyer is gradually fading and a market reversal is approaching. That is, when the bears take control of the market and lead it in their direction. Let's analyze the first figure, which is the triangle. It comes in different shapes. In this case, we will discuss the wedge, which can be upward or downward, as well as a rectangular triangle with a gradual price squeeze. So, we know that the rectangular triangle is a continuation pattern. How can we understand when to use this figure? This figure should typically be used in cases when the market is at its peak or in its decline. So, we have an upward structure. Note that each subsequent time the price will simply touch a certain level of resistance without updating the price maximum. This will tell us that the structure is not broken, but it also has not continued its movement, meaning it has not renewed its movement. In this case, logically, we can understand that the reaction from the resistance level was of a certain strength. The next one was weaker, then even weaker, and so on. In this case, by simply understanding and analyzing the price movement, we can see that the interest of the bulls was greater than the interest of the bears in selling. Based on the momentum, that is, the strength of the reaction from a given level, we can further understand what to expect from the market. So, how do we understand how to trade? That is, where will our entry point and exit point be? Often, we generally make an entry point either from a breakout of a level or from a lower touch. I often do not trade on breakouts because I am usually not satisfied with the risk to reward ratio in that trade. So usually I trade from the lower touch of the triangle, placing my stop loss either behind the previous extreme or behind the one before the previous extreme. Now let's consider where to set the take profit. Often it is placed in two locations. Either it is at the golden ratio according to Fibonacci numbers, also known as the number of God, or it is the realization of the potential of the very base of this triangle. The second option for exiting a position will be to mark the potential of the triangle by noting its base and applying the start to the point of the triangle's breakout. In this case, it will be exactly this point. Often you can set one or two take profits. Friends, it's simpler with the wedge. In this case, we have a downward wedge. This is a very strong figure that often helps to invest very well in assets or trade. Remember that the higher the time frame you use, the greater the chance of your pattern playing out. So, the wedge looks like this, and its feature is that the strength of sellers gradually diminishes, and trading activity slowly decreases, and decreases until the bulls take the initiative and break through this pattern. The potential of the wedge is usually a bit small, and trading it does not make much sense. Therefore, I usually often use other methods to determine the exit point. The first method is the Fibonacci golden ratio number, which is a price value of 1.618. In this case, our take profit will be set somewhere around here. Sometimes the golden ratio is not enough to precisely determine the exact exit point from a position. Therefore, pay attention to the local minima and maxima of the previous movement. There is usually liquidity behind them. Or you can focus on certain areas such as imbalances in the market, what we will talk about in the next videos. Subscribe, don't miss out. Now let's consider the double top touch pattern. It often forms when the price typically approaches closely to a level of resistance or support. This figure has nuances. Even experienced traders miss. Let's break them down. The first nuance: how to understand whether the price will continue to go down from this point, forming a continuation of the trend, or if it will reverse and go back. Friends, it's quite simple. If we see a double top touch, we need to wait for some kind of reversal candlestick pattern. That is, these can be pin bars, hammers, rails, engulfing patterns, and so on. We will also talk about this in other videos. So, you will be able to successfully apply this figure if the second touch is slightly lower than the previous one. Or if we consider this example, the last touch in the case of 3 touches will be higher than all the others. This means it will take the very last liquidity, remains there. And if it goes into a reversal, meaning you should definitely pay attention to such manipulations. So, in this case, if you see that the price has gone slightly below the previous low, you can confidently enter a trade when you see a formed reversal pin pattern. The entry point, according to classic technical analysis, will often be set from, let's say, a conditional neck level, that is, the level that I have marked. Noting somewhere that blood is there, I trade this figure differently. I often wait for this reversal pattern, then enter with confirmation after it. This is usually a dawn or sunrise pattern. So, when I have a complete understanding that the market is at its lows, and the last liquidity is being taken out from here, a reversal candlestick pattern is formed. I can confidently enter a trade with such risk, setting my take profit somewhere above the market. Again, focusing on the imbalance or subsequent liquidity that the market will leave behind. Also, according to the classics of technical analysis, not the smart money concept I explained to you on how to exit a position, we can rely on the potential of this figure, that is, its foundations. The logic is the same. We take the breakout point of the conditional neck level, and we mark it. The end of this level will be our exit point from the position. This is the example we discussed regarding the double top touch. What about the triple touch? Friends, how can we understand if a triple touch is forming, or if we should enter on the second one? If we have a small manipulation like the one we just discussed at the second touch, then it is likely that we should not expect the next touch. However, it may happen. Another nuance to consider when trading this figure is that often in such situations, there may be a prolonged flat, meaning a prolonged sideways movement. Even if this sideways movement is forming and you have already covered your position, you will always remain in profit, in that good profit, because you will always be able to exit at the base or somewhere here in the middle. Nevertheless, this pattern remains very good in terms of pin rate as well as risk to reward ratio, so trade accordingly. The next very good figure is the head and shoulders. So friends, how is it formed? The logic of this figure is very simple. So, the price movement that will occur from the head to the next shoulder will usually happen around the level of the beginning of the previous impulse. That is the neck. So, if we see that there was a strong rebound, meaning we had an upward structure, and at some point suddenly there was a strong movement in the market, and the price has retraced almost to the beginning of the leading impulse movement. This indicates that there is significant interest from sellers in this case, and they are starting to push the market in their direction. We are waiting for the formation of this shoulder from which we will enter. Be sure to wait for the formation of this shoulder, because it often happens that the bulls may continue to push the market upward. But if this shoulder forms and the price reaches the neck level again, you will understand that the strength of the bulls has weakened and the bears are taking control of the market. In this case, according to the classic approach, we trade as follows. At the moment of the breakout, we set our entry point, place our stop loss behind the previous shoulder, and set the take profit based on the potential of this figure. That is, we mark it precisely and carefully from the neckline to the head and from the breakout point. Alternatively, you can use Fibonacci numbers in the same way if the previous method did not help you. And overall, do not forget to pay attention to liquidity or imbalances. This applies to all patterns in the market. Friends, here is the situation. The market will not always present perfect figures, and often the neckline can be very skewed. In this case, considering the context from the perspective of technical analysis, it's all the same, just upside down. But looking at this situation from the perspective of smart money, we can understand that we had a downward structure, after which our high was updated. Be sure to keep in mind the price must consolidate here, meaning the base of the candle should settle above. If the base of the candle has settled above, we can confidently understand that there will be a reversal in the market, so we can expect a price reversal. The entry is the same. Friends, now a very rare but no less valuable figure. I love it very much, but unfortunately it appears in the market very rarely. Here are two variations of how it can appear. This figure is called cup and handle. The situation is that in the first scenario, we see the price movement, and at some point the price may simply hit a level of support or resistance. The logic is the same. If we see a very sluggish reaction from this level and the price gradually keeps returning to it, there can even be 3 touches. In this case, it will be a triangle. However, if there are 2 touches, it is often a cup and handle, which specifically refers to 2 touches. In this case, the price usually continues its movement at a good pace, as it was moving before. When the market has been in a downward structure and the price gradually loses its activity and shifts to a similar movement, we can understand that the market is likely to reverse. The price potential is the same. I don't see the point in repeating this. The entry points we use are the following, very similar to those with the head and shoulders pattern. At the moment of the breakout, we enter the trade by placing our stop behind the handle, and our take profit at the level where we expect to see the price. Everything is exactly the same, either based on the potential of the figure itself or on the golden ratio and other circumstances. So, now a couple of examples from the real market. The Bitcoin asset is on a 1-day time frame, meaning one candle represents 1 day. In this case, a wedge has formed, where the distance between subsequent highs gradually decreased. At some point, the wedge broke out, and the price began to move downward. So, the best take profit in this case is the golden ratio according to Fibonacci. I marked the lowest point of this wedge and the highest point of this wedge. In the future, we will expect the price to fully realize according to the golden ratio. As you can see, this is exactly what happened. In this case, we have 2 entry points. The first is the moment of breaking out of this wedge. We can enter here. If we miss this entry point, we can wait for a price correction to this level and then enter from there, placing our stop loss below the previous high. And so, in the end, we have a great trade with a risk-to-reward ratio of 1 to 5. Friends, the next situation is head and shoulders. Here we see the first shoulder, here we see the head, and here we see the second shoulder. In this case, I marked the potential of this figure for myself, the breakout point. And somewhere here at the breakout point I could enter. Also, the take profit can be set at the level of the golden ratio. In this case, both take profits would definitely be very good. Note that the best take profit here coincided with the filling of this imbalance. Again, we will discuss this in the following videos, but indeed, the best take profit point is often exactly where several factors coincide. That is, how at this moment the potential of the figure coincided with the market imbalance. The next figure is a triangle with price compression. No. In this case, we see a triangle with price compression. We have a very strong support level remaining, but at the same time the price is gradually pushing through it, getting closer and closer to the plateau. And at some point it will be realized. Again, there are 2 options for take profit. The first and the second, both are good. We can rely on history, examining how things progressed afterwards. Perhaps there will be reference points. So, the asset is Ethereum and the time frame is 4 hours. I want to show you an example of a triple touch. So, we have some level. There is the first touch, the second touch, and the third touch. Note that everything has come together in the best possible way. That is, after the second touch, we waited for the third touch, which was lower than the previous two, while the price did not close below, meaning it was just a wick of the candle, and at the same time we formed a candlestick reversal pattern. In this case, according to technical analysis, I would note the potential of this figure. I would place it here, and I could calmly wait for my take profit. In the case of the golden ratio, it's exactly the same. They roughly coincide. Friends, and finally, let's analyze the trading model cup and handle. So, in this case, we have the asset gold, where this figure has formed on the daily time frame. I marked the cup and its handle as well as the conditional neck level. So, classically, my trade would look like this. I would wait until the candle confidently closed above the conditional neck level. In this case, we see the closing of the candle here. This is roughly where my entry would be. According to the classic approach when trading this figure, the stop loss is set below the minimum of the handle, that is, below this local extreme. Now let's calculate the potential of this figure. Here everything is classic. I mark the distance from the neckline to the lowest point of the figure. In this case, it is located at this point. From now on, I will be focusing on the breakout point. In this case, my take profit should be set approximately here. Friends, also subscribe to my Telegram channel and choose the language that suits you best. In my Telegram channel, I will share my trading ideas, my vision of the market, how I manage my investment portfolio, and how I distribute profits. Follow along, I do everything for you, and it is free. There is a lot of interesting information about the market, both in trading and in investments. You can see how I manage my investments, handle my portfolio, and distribute profits.